Well, good morning and welcome to another one of our Wednesday live stream panel discussions for entrepreneurs, startup founders, innovators, and investors. I'm Brett Waters. I've been in Silicon Valley my entire life. Today, I do a little teaching at Stanford University. And this morning, I'm on the beautiful campus of Santa Clara University, where I'm here to give a talk on my new book called The Launch Path, which you can buy at Amazon or Barnes & Noble or wherever you please. Glad you're here. So also joining this morning is my friend in the taco business, Louis Lowe.
Brett, thanks for having me. And every time you turn that jingle on, it just gives me I know we're going to talk about one of my favorite topics.
So. Exactly. All right. So Louis, give us the brief introduction on yourself. How long have you owned a taco truck?
I am a Silicon Valley lawyer, and I've been practicing in the Valley for 20 years. But today I am in Gotham City in our New York office. Thus the tie, and you can see the smoke coming out of Gotham's armpits.
In Silicon Valley, we're not used to ties, Louis.
I know it. You got to mix it up. But there are startups here in New York.
I've heard that. Also joining is Natasha Allen. Hey, Natasha.
Hi everyone. Natasha Allen. I am also a Silicon Valley lawyer, wearing a jacket in Silicon Valley, so that's all right. We mix it up here too. I've been practicing in this area for quite some time. I'm not as bold as Louis to say how long, but I am long in the tooth. And just excited to be here to talk about term sheets and what to look out for.
And Natasha and I together co-lead a team that represents several hundred emerging growth companies at all stages of growth, growth agnostic, stage agnostic, technology agnostic, as long as you have some. And we are known for using technology tools to accelerate the growth of our startups and to have practical and commercial solutions that make sense, which is why we have this podcast.
Excellent. So Louis and Natasha, here it is, January 2024. And, I think that everybody is in agreement that it's a whole different economic environment, especially for fundraising and M&A, than it was 2 or 3 years ago. And, of course, the heart of most financing transactions is some sort of a term sheet that gets issued that outlines the terms by which an investment will be made. And then once the parties agree to that, the lawyers turn that into a set of definitive documents. So term sheets in my career in Silicon Valley, term sheets, kind of evolve over time in terms of what is considered normal and standard. And now we're in a slightly more complex fundraising environment. And on top of that, there's kind of more different financing structures than ever, right? There's not only the straight equity venture financing, there's convertible notes, there's safes with side letters, there's kind of all kinds of different variations on the theme. So, Louis, maybe you can just start us off by, what you are seeing in terms of trends right now in terms of the Silicon Valley financing transaction scene.
Thanks for asking, Brett. And I think what you've just described is fundraising in high resolution. So what Natasha and I try and do is help our clients bring in capital in whatever way we can. The best way to bring in capital, of course, is from customers, which don't dilute you. Another great way to bring in capital is through the Small Business Administration or some other government program that, again, doesn't dilute you or doesn't have any kind of guarantee. But oftentimes, to get the kind of growth that you need to get to the next benchmark or metric of success that you need to hit a financing target or some sort of an exit, you need capital to fuel the growth, and that can come in one of various ways. The first way would be just selling common stock. This is a terrible thing to do, though, when your company is pre-revenue or in early stages of revenue, or even in later stages of revenue. Until your IPO, you don't want to be selling common stock. You then could sell preferred stock, which is what the venture capital firms want, but there you're going to have to negotiate a value. And right now is a tough time to be asking for a fixed valuation, as the outlook from venture firms is pretty much on the down low. And so what we really would like to do is sell a security where we can decide what the equity value will be at a later date. at a later date when you have hit some bigger revenue markers. And so the two instruments that we use to defer that valuation would be a simple agreement for future equity or a convertible note. A convertible note is the old school way of doing it. Typically, you'd have a 20% discount to the conversion price that a future Series A or Series B investor would pay. You're typically have a maturity date of 2 to 5 years. You have a low interest rate, which is usually set at whatever the Fed rate is, so 6-7% right now. And sometimes you'd have security if it was, especially if it was a bridge round. Otherwise, you wouldn't. And so the teeth there is the maturity date. A SAFE is something that the Y Combinator Accelerator came up with 10 years ago. Very founder-friendly instrument. It isn't equity, it isn't debt. So what is it? Well, it's a contract, and you have to pay it if ever you were to liquidate. But it has no maturity date, and it converts into equity if and when you raise a future round. So those are the the zooming out the high-level instruments, Brett. And right now, what companies are still trying to do is continue to raise at a flat round, avoid the down round, and if they do have to do a down round, doing it with a SAFE or a convertible note that just has a lower cap. Again, that simply postpones the recognition of the down round until you have that next round of equity. So I've said a lot, and I'm going to stop there and let my partner Natasha correct me as she always does.
Not at all. I agree. Those are the instruments that you typically see. One of the things that used to be in play was venture debt, but I think given the trend, so I think really what's happening right now is there is more of an investor-friendly trend because a lot of the amounts that were raised 2 years ago, people are coming to the end of their runway. So there is some need for people to get cash. And whether that be through one of the instruments that Louis said, venture debt is probably not very viable because typically you need about 12 to 18 months runway to even be eligible for venture debt. But you do have that push-pull between existing kind of investors and investors that want to come in now. So it's just in terms of trying to figure out, obviously if it's an investor-friendly environment, the older investors might get crammed a bit in terms of the new terms that are coming out. You're seeing things like cumulative dividends coming in, the liquidation preferences being a little higher, and that's usually for late stage companies like growth companies. You're seeing, but those are the key things, like in terms of terms that are kind of causing a bit of a push-pull between your existing investors and new investors that want to come in right now. Also, you're seeing stacking. Right. Typically, when you do these financings, all the preferred stock are on the same level. One doesn't, stack above the other. But new investors now are somewhat looking to get that preference because, again, like I said, the cash is running out, and people are looking for capital.
So, I imagine that we're starting to see some bridge financings as people run out of money and the current investors want to kind of step up and keep the lights on for a little while, hoping to get some new investment. So are those bridge financings, are those typically structured as convertible debt, or how are they typically structured, Natasha?
So I've seen both, right? SAFEs are usually the ones that are at the top forefront, but it depends on the ecosystem you're raising in, right? Some other ecosystems for venture financing are more comfortable with convertible notes, but typically you see SAFEs are still kind of leading the charge in terms of bridging the gap. Yeah.
I would say that opening a SAFE as a bridge is an optimistic signal to the market. Using a convertible note right now is perhaps less of an optimistic signal to the market. And so when I sit in board meetings and we talk about, well, we're going to need a bridge of, a few million between now and when we hit 10 million, which is the time to start raising the B, let's open up a SAFE, let's have a high valuation cap, let's have no interest, no maturity date. And that shows that we're all feeling good about the company. Now, on the flip side, if people are tired of extending these bridges or are getting impatient, maybe they're going to open a convertible note. Maybe it's going to have a short term on it to signal to the market that, in fact, we do think we can convert this thing and raise our next round within a year, within 6 months. And so there is no right answer, and there are many ways to cook a sauce and to make a taco, Brett.
Many ways to make a taco. You're talking my language now, Louis.
Exactly.
So I had the experience once founding a company. We structured the seed round as convertible notes. And 2 years came and went, and we did not successfully raise a priced round, a Series A. And interestingly, the way the notes were written, it wasn't clear what happened. Well, it was clear, which is the note was due and payable, but we didn't have a way of paying it. And so, luckily, in that case, it was a pretty friendly investor group, and I simply called them all up and said, "Hey, why don't we just agree on a valuation and convert all this to equity at this point, rather than leaving these notes open?" And that worked out fine. But it certainly made me realize that if you don't think about various eventualities and kind of document what happens, clearly on the term sheet and then in the docs, that you can find yourself in a situation that is kind of undefined and scary.
Yes, so startups who are raising capital should always be working with counsel. Counsel should be tracking the issuances of the capital in some sort of cap table software tracking mechanism.
Yeah.
Everybody used to love Carta. Since a month ago, they don't love them so much anymore. And there's AngelList, and there's Pulley, and there's Shoebox, and there's several other great solutions. And if anybody can reach out to Natasha and me, and we can share with you what these are. But you've got to be very cognizant of when these convertible notes come due. And I suspect that as we get deeper into 2024, investors are going to be less and less amenable to extending the maturity date on those things.
Yeah.
As Brett, you don't always have to convert them. And again, that's an accommodation. Those things have to be paid back or extended. And so extending at least allows the investor to continue to accrue interest, whereas converting, you're agreeing on a price and there's no more interest.
Mm-hmm. Jordan jumps in with a Carta alternative called Ecvista, I guess. I haven't heard of it, but I'll check it out.
Sounds like we need to have a separate webinar on that whole topic.
Exactly.
So Remy asks a really good question, which is that we were a minute ago we were talking about bridges. What does that mean exactly? And Remy says that for him they're currently at a B, so they're expecting to raise a C. So what the hell's a bridge?
So a bridge is just pretty much money that you get in, capital you can get in by, like we said, by way of convertible note or SAFE, that allows you to get the metrics in place to raise a successful C. So if your valuation isn't what you want it to look like, or if you don't have the metrics in order to raise a C, you can ask for internal investors to put more money in to bridge the gap, right, between making those metrics versus having external investors come in to help bridge the gap. But that's essentially, it's just getting in capital to make sure that you have enough money and metrics to meet the next round of financing.
Right.
Or to a sale. You could bridge to a sale.
Or a sale, yeah.
Or bridge to a sale, right. So, Louis, I always laugh about how the whole idea of a SAFE was that it was a lightweight document that would replace convertible notes.
Mm-hmm.
And now everybody's loading up safes with side letters that make them 10 times more complex than they should be. Mm-hmm. So we're completely gotten away from what the original idea of the safe was, that it was a lightweight, simple document.
Yeah.
But talk to us a little bit about side letters and what that means.
Yeah, so a SAFE is a document that is posted on the website of Y Combinator. And it should say on it that nothing has been changed to the Y Combinator SAFE except to fill in the blanks. And if it doesn't have that language, then that means you are looking at a SAFE that is not a SAFE. It's something an investor downloaded and changed. And it's very funny. I see all sorts of variations of people trying to say that what they're serving up is a SAFE, but sometimes it even has a maturity date and interest.
That sounds a lot like a note to me.
Hybrid.
Well, that's not a SAFE. That's a note. No. It's just got a couple changes.
Yeah.
So that's one variation of what I'll call a dirty SAFE. But the other is, and I wouldn't call it dirty. I think during the heyday of 2021, as things were moving so fast, investors were writing bigger and bigger checks on these safes, and they weren't getting all the information they needed, both to make an informed investment decision as well as to monitor the investment thereafter. And so they started to try and boil down the critical parts of the investor rights agreement, the right of co-sale agreement, the voting agreement, and boil them down into a short document that they called a side letter. These are very important documents for investors to feel like they know what they've got, and they know how to value it going forward. So if you're looking at a company and they say they have safes, assume there are side letters and demand to see them, so that you know the status of the company and who has what rights, when, where, and how.
Exactly.
So we question here about C Corp raising dollars, safe and convertible. Are the funding amount publicly available?
Great question. And the baseline answer is no, except that one of the many reasons, if you're an entrepreneur raising capital, that you need counsel is that there are federal and state securities laws that apply. Yes, they do. And one of those is that you have an exemption from registration with the Securities and Exchange Commission or the relevant state securities commission. And we typically will satisfy those by filing what's called a Form D with the Securities and Exchange Commission. And a Form D is publicly available, and it has some information about the maximum amount of capital that you raised, and in some cases from who. And it's required to be signed by officers and directors. So looking at a Form D will tell you something. And then certain states, if you don't want to file a Form D, you'll have to comply with the state securities laws, as the federal filing would supersede the states. And some states have publicly available information that's filed and available, but it's very hard to find. So the short answer is look on the SEC.gov website if you're looking to find out whether a C Corp raised, and if they did their job right, probably it's there.
Yeah.
And then following up on that, Jordan's asking about best states, if not Delaware. So as most of our listeners know, Delaware has always been kind of the default choice to incorporate a business in for a venture funded business. But increasingly, you're seeing some alternative jurisdictions, right, Louis, Natasha?
Yeah. I think I had heard that Nevada was trying to have businesses come and incorporate there. Typically we see, obviously we always say go Delaware, and most investors say convert or, to Delaware. But I would say Nevada. There was also, what was one of the
Wyoming?
Wyoming, yes.
Because of digital asset legislation there is very well
established. Yeah.
And I would say Cayman Islands is another place where you have some sophisticated rules, and some non-U.S. investors prefer to invest in a U.S. business through a Cayman vehicle. So for tax and for other privacy reasons, those are all places that we see companies forming.
It's outside the scope of this discussion, but for Latin American companies these days, they're often doing a Cayman sandwich.
Oh yeah.
You have the investment going into a Delaware C Corp, and then a Cayman Islands entity that is the holding company, and then the Latin American company that's the operating company.
Absolutely.
Yeah.
It's almost as good as a taco, but not quite.
So, what else, Natasha? What are you seeing in terms of trends as we enter 2024?
In terms of trends, I would say that the environment is pretty difficult, right, in terms of getting term sheets, but there are term sheets floating around. Yep. And like I said, it's that push-pull between existing and new investors coming in that, the boards and founders will have to grapple with. I've seen that, January has been a lot busier than December, but I don't know if that's indicative of the rest of the year. But definitely think that companies will have to be grappling with some of the more, investor-friendly terms, and really figuring out, does it make sense to raise now or wait and try to do a bridge?
Yeah. So Brett, one trend that we're seeing intensely right now are venture firms looking at, when did they raise, how much dry powder have they spent, and how much dry powder remains, and when do they want to raise their next fund, and then minus how much do they need to hold in reserves to fund follow-on rounds of the companies that they've already committed to. Some venture funds that would be a zero because they don't do follow-ons, but many do. And I think one trend we're seeing is that venture funds, in 21 blew through their powder faster than ever before, and it took them a while to slow down in 22. They slowed down a lot in 23, but I think they're still a little bit ahead of schedule. You time that together with the fact that they have to market the value of their investments every quarter, and they have to look at the public markets in order to do that. And while the fantastic 7 exploded in value in 2023, the rest of the market did not. And so the comparables are not very excellent. And so for the limited partners that invest in venture capital firms, they tend to look over extended on venture when you combine the mark-to-market valuations that they have and the assets that they're currently holding. And so all of this means that 2023 was a slow year. We've seen just a lot of new activity so far in 2024, so I'm very optimistic about the year. But a trend is that these venture firms are looking at their portfolio and they're saying, okay, this one is the one that really I want to put my time and money on. This one's a maybe. These guys are never going to make it. So the ones that are never going to make it, they certainly don't want to take a write-off to zero. They'd like to see some sort of an outcome. And so they're telling them, hey, why don't you go talk to my portfolio company over there, because you're really adjacent or additive, or they could use your team, and you still have some money in the bank. Why don't you combine? And so we have a venture financing via combination, where you have two companies that really couldn't raise in the market right now. They each probably have some money and some talent and some product. And there's one bigger one and there's one smaller one, and you're going to put them together. You're going to probably riff a lot of the employees. You're going to go keep the best of breed, and you're going to announce you've just raised the amount. The larger company will announce that they've just raised whatever was in the bank of the smaller company. So that is the venture capital transaction via M&A.
Right. Take two sinking ships and tie them together, hoping it'll float.
Want to float?
Well, I don't think the larger ship is a sinking ship,
No.
But it can benefit. And one of the questions is, well, what do you pay them with? You pay them with stock. What kind of stock? Is it preferred or common? And then what rights do you give? And there's the push and pull.
Right.
I think also another trend is also that there are funds that are being still funded now. I think at the end of last year, not a lot of money was going into new VC funds or new, it was very hard for VC funds to raise. And I'm finding that there are a lot more out there that have liquidity and are willing to deploy. Like Louis said, he's optimistic, but I guess we'll see.
Mm-hmm. So Louis mentioned a minute ago the Fantastic Seven, which is actually not a new Marvel movie. It's the New York Times earlier this week had an article about how most of the gains in the stock market last year were from just 7 tech companies: Amazon, Microsoft, Alphabet, Meta, etc. So let's see. There's a lot going on right now, I think. And I think, Louis, one of the things I always ask you is whether or not you've seen much in the way of alternative investment structures, and you always say no. So when I say alternative investment structures, I'm talking about things like a note where the payments are defined as being a percentage of revenue share note, stuff like that.
Still not seeing that stuff.
Okay.
No. Investors who are putting in money, they want the gold standard with all the bells and whistles. And I'm not finding a whole lot of appetite to finance other people's payables. I'm finding that debt is it's out there, but it's very hard to come by. Natasha mentioned venture debt and bank debt, and I think venture debt, you can only have it if you've raised money from a tier 1 venture capital equity fund, and in the several months thereafter. Otherwise, forget about it. And the number of venture debt providers has really changed since the regional banking crisis of last spring. They're still out there, but they're kind of recomposing their teams and trying to figure out what they can do. And then bank debt, I think, as the standards for lending have gotten even tighter, interest rates higher, and it's just hard to come by. So you come back to people want equity at very low prices with a lot of rights.
Yeah. So Jordan has very helpfully provided us with the list of the Fantastic Seven. So we've got Meta, Facebook, we've got Amazon, Apple, Alphabet, Google, Microsoft, and Tesla. Those are the Fantastic Seven. So let's talk about governance for a minute. I was thinking about how many of the most spectacular explosions in the startup world last year were governance related, right? So we had FTX, which is, by some bizarre situation, investors had put hundreds of millions of dollars into a company with no board of directors. And Sam Bankman-Fried was just out there spending money. I think SVB at some level was a governance issue. And certainly OpenAI was not a failure, but OpenAI was a lot of drama around governance issues. So, certainly in an equity financing, the term sheet usually will specify board composition. It'll say something like this: 5 members of the board. There will be 5 members of the board, and 2 of them will be chosen by the preferred shareholders, 3 of them will be chosen by the common shareholders, yada yada yada. But I just wonder whether each of you could kind of talk to that, and whether you're seeing more requests for governance processes given what's happened in the last couple of years.
Yeah, I'm happy to start. Natasha, interrupt me. We saw the explosion of the side letter to the SAFE because early stage and seed stage companies were raising, sometimes $25 million, sometimes even more on a simple SAFE. I mean, it used to be that Series A was $5 million. Last year, more like $9.
That's crazy.
The safes really were designed to be $1 million checks, and now they got larger. So investors started to say, hey, there is no governance in a safe, so we've got to set this out in the side letter.
Right.
It's very important that investors get access to annual, quarterly, and even monthly financials so that they know how to value the company, and when things start to go sideways, they can intervene. Say, what's going on? Where did the money go? I have an investor client that demands access to the bank account so that she or he can see the bank balances at any given time. That's the way to protect yourself against fraud.
Right.
But
there's two things there. One is information rights, right? Yep. And the other is governance. So information rights is, I want to be able to see financial statements anytime I ask for them. And governance, things like board governance is usually something like, expenses over a certain amount need to be subject to board approval.
Or how about related party transactions?
Related party transactions.
Exactly. Right. And even the composition of the board, right? So making sure that there's independent investor or independent board members, or allowing for seats for strategics, right, to come in. That's also something else that a lot of companies are looking at, just to make sure that your board is a little diversified, especially in this climate, right? If you can't get a lot of cash, why not get a strategic that can help get cash through the door?
And so, how often do you see this on a term sheet?
In terms of board composition?
Yeah.
Hopefully every time. I would say add it in. Add it in. If it's not in there, add it in. And if you know who you want to have on the board, put the names in and just have it all set out. I think, and I don't know whether you can agree or disagree, but I think the more you put in the term sheet, the better it is, because it's pretty much your roadmap to the main docs. If you have something you want to hash out, argue, get it in the term sheet, get the arguments over with. so that when it comes time to drafting, there's no surprises.
Yeah, I think that is a super important tip on this whole conversation is don't wait until you're editing the final, reviewing the final docs to suddenly think of something you want to put in there. Get it on the term sheet, and that's a good segue into Jordan's question, which is how negotiable are term sheets? So Andreessen Horowitz hands me a term sheet saying, we'd like to invest $10 million. Here are the terms. Is it a take it or leave it thing, or how much negotiating can I do?
Great question. So the NVC, the term sheet that venture capital firms use was standardized 20 years ago and put on a website called nvca.org, the National Venture Capital Association's website, and it gets updated yearly. There's a company called Omni that's attempted to automate it and who publishes some really great data, especially if you pay for access to their database. You can get up to the minute data, which is pretty incredible. Love that product. And it tells you, which, based on anonymizing data from millions of transactions, what terms are negotiable when and where. As in all things, there is more art than science to what you can negotiate. The first and most important thing is to understand the valuation, and your counsel can help you understand what the valuation is by reading the term sheet and reading things like what's the pre-money and what's in the pre-money, and are they making you expand the option pool as part of the pre, or is that going to be in the post? What is included in the pre in terms of the existing notes and safes? Or they should be in the pre, are they, or are they not in the post? So the first and most important thing to understand in the term sheet is the valuation, and I always recommend attaching a pre and post money pro forma capitalization table as an attachment to the term sheet, so there's no about what gets counted.
Right. That's good advice. I also, a couple of years ago when the whole frenzy was going on, every startup wanted to announce their next financing and the valuation, right? It was this, it became this vanity metric that, our last round was at a $3 billion valuation. And what I saw happen a few times was that because the founders were so hung up on wanting that number to be high for the sake of the press release, they would give on other terms in order to up the valuation because of the press release value, which I think is generally a bad idea, but.
Very, very much so. I think that also the approach with when you're looking at term sheets for companies and negotiating, think about what are the key things for you. What are your key things that you can't live without? Right. Because there's always going to be a push pull. You're going to have to give something for the money that's going to come in. But if you have a good understanding of, look, these are the things that I don't like. I don't want to give up board control at this stage, or I don't want to be super diluted at this stage. So for me, the valuation is key. But think about the key things that you really, really cannot or don't want to give on, or want to give very little on, and then the rest will, lay where it will lay.
Yeah. Well said. I always say, board control. Is it time to get reloaded for more equity? In other words, you, the founder, are you being diluted by how much? What's left in the pool? Can you tap that? Can you get a commitment to get more equity out of the pool post closing? In the heyday of 21, we were seeing most term sheets had some liquidity for the founder. They were actually selling stock. Not so today. Not so today. That trend has gone away. Investors do not want to be funding founder liquidity right now. Right. Picking spots. Another spot that I think about often is if the founder does want to have some liquidity later, will they have some percentage of their stock that is exempt from the ROFR? Maybe it's 2%, maybe it's 5%, maybe it's 10%. These are all kind of negotiable things. The investors are going to ask you to pay for their legal fees.
Yes. Be careful.
Putting those in a box and in a cap is something that you're going to want to look to do. Understand, who it is that they're going to be using, and so if they're using one of those big law firms that puts 10 lawyers on every deal, the number is going to be big, and address that in the front end, because if you don't do it, you're toast after the term sheet's signed.
Exactly.
I remember the first time I encountered this, first time I got a term sheet that said that I was going to both pay my legal fees on the transaction, and I was also going to pay the VC firm's legal fees on the transaction. And at the time, it was, I think, maybe around 30 grand on each side. And, and my reaction was, how does it make sense that I'm paying their legal fees as well as my legal fees?
The same when you borrow money from a bank.
Yeah.
The rationale, of course, is that they want the transaction expenses to come out of the fund and not come out of their management fee.
Right? Exactly.
Right. So Jordan asked for clarification, Louis, on related party transactions. We used that term a minute ago and didn't define it. So
yeah, related party transactions are transactions between the founder and the company. So the quintessential example is FTX borrowing money from, lending money to Alameda Research, which was Sam Bankman-Fried's personal hedge fund. That was an example of a related party transaction that was not authorized, nor was it approved.
Adam Newman, the founder and CEO of WeWork, famously, he personally bought the trademark on We or WeWork, and then he sold it to the company for $6 million. And that doesn't tend to go real well when the board finds out about it.
Good thing to have counsel who can arrive on the scene and perhaps get those approvals when the moment is right. Right. We see many transactions that are technically related parties. Those are voidable under Delaware law, unless they've been ratified by a disinterested board or by disinterested stockholders. So there are ways to clean those up, and there are footfalls. And again, good counsel can identify and solve those.
Great. All right, guys, this has been great, but I think it's time to bring this exciting discussion about term sheets to an end. But let me ask each of you, kind of just as a way to go out here. Natasha, what's your kind of high level advice? If you've got, let's presume from the founder side. So if you've got a founder who says to you, I think I'm going to be getting a term sheet next week from mega big ventures, what's your advice to them?
First thing I would say, long pull is usually diligence. So make sure your documents are sorted. You have some type of data room. Get your counsel working on that. Second thing I would say, do not sign the term sheet before I review it. Right. Sometimes we get in a circumstance where we're handed a signed term sheet and said, okay, work with this. So absolutely would say, do not sign it, have legal counsel review it, go through it with you. And as I said before, think about what are my non-negotiables? What are the things that are key to me at this stage of the fundraise? And it may be, I just need money in the door. That's fine. But go in with your eyes open and understanding kind of what you're willing to give up versus what is non-negotiable.
Right. And I should say that I think most term sheets are non-binding, right? But it's still pretty embarrassing to sign it and then come back later and say, oh, you know what? After I talked to my lawyer, I have a few things I want to change.
I want to change. Yeah. Doesn't look good. Not a good look.
So even though it says non-binding, don't sign it until you've had a chance to discuss it with counsel.
To my founder friends out there, your job is to inspire and enchant the investor all the way until the money is in the bank, and it doesn't end there. It continues thereafter when you're in a new relationship, which is really like a marriage. But in this interlude period where you're courting and you're trying to land this investor's check in your bank account, you're constantly responding to requests for information. And it's only towards the very end of this process, usually after you've met all of the partners in an investment committee, that you'll be given a nudge by the lead investing partner from the VC, and they'll say, hey, I'm going to be writing a term sheet in the next week. And that's where you should stop and say, hey, talk to counsel. And this is when, I'm going to have that conversation. What are those 5 things, or what are those really important things? And maybe, there's an opportunity to swap out a director that is not constructive. Maybe it's some liquidity that you need personally. Maybe it's that you need, your employment deal reset. But it is a sensitive thing that you present a few asks to your investing lead partner before they write the term sheet.
Yeah.
It's really helpful if you can slide those asks in before the term sheet, so that they get it authorized in the first go, and it's not something that you have to negotiate after you've got something in writing.
Or even some of the terms, like I was saying, that are the non-negotiables after you see. It's sometimes better to go back to your business folks and have the conversation as opposed to lawyers sending red lines back and forth, right? So sometimes it is good to go back in the beginning. Like Louis said, you are the apple of their eye, so use that to your advantage.
That's all really, really good advice. All right, Natasha, Louis, this has been a great conversation. Where can folks find you if they want to reach out to you?
You add my name in the Google search engine, and there's no hard to miss me.
Hard to miss. And you can find me at Foley. So, and Alan at Foley.com. Happy to chat. And Brett, thank you very much. This was a wonderful event.
We're going to post the recording of this on our website, folleyignite.com. It is a great source of information for founders and investors. It's got a document generator. It's got blogs. It's got webinars, and lots of resources there for the founders out there. Thanks again, Brett. Thank you, Natasha.
Nice job getting that plug in, Larry. Nice to see you guys.
Bye.
Thanks for joining us for another of our Wednesday discussions for entrepreneurs, innovators, and investors. See you soon.